Good morning. When we think about the question, what is a socially useful financial system, the first thing that we need to say to each other is, well, what do we mean by socially useful? Let me put it. And that's why I will spend the first 8 or 9 minutes talking about, well, what criteria do we have for saying that a credit sector is socially useful or not? And then we'll look at some empirical indicators to apply that framework. Now, the first thing to notice about this is that conventional cutting-edge macro monetary theory here is of no help at all in determining what is a socially useful credit sector, and that's for the simple reason that there is no credit sector in the cutting-edge macro models today. Okay, this goes back to back a long way. Frank Hahn in the 1960s wrote a paper on problems of proving the existence of money in the multi-market equilibrium economy. So money itself is not supposed to exist even, right? Now, this has been, laid out and explained in many publications since. And my point is not to bash macroeconomics as it is today, but my point is that we really need to look for other models and other ways of thinking if we want to get to an assessment of what is a socially useful credit system. Supporting these, you might say, these science fiction models, financially speaking, because there is no finance in them. The models that central banks use have no banks, just let that sink in. Supporting these science fiction models is fictional history, is a history where people in primitive times supposedly bartered and then hit upon the idea of starting to use lumps of gold or shells or whatever to replace the cruder barter trade, and then later on credit came, which is money lent out. In reality, I mean, there's absolutely no historical evidence for this story, which you can read in many textbooks, and I'm sure many of you are aware of this. In reality, it's exactly the other way around. So moving away from fictional history supporting science fiction models, let's look at reality in order to build science of economics for the real world. These are not people in the dock, these are not criminals, these are top economists testifying for the US Senate in summer 2010, hearings under the title of Building a Science of Economics for the Real World. Can't remember whenever US Senate had been interested in this topic, so it's a great time to be an economist. Doing that requires that you're interested in reality. And the reality shows that credit and debt relations have existed as long probably as humanity exists. If we go back to the oldest known civilizations, highly developed civilizations of Babylonia and its predecessor Sumer, Michael Hudson and others have done great work in this area. Over the last 20 years, a lot of research has come out which shows how sophisticated the credit systems really were that these societies had. What you see here is one of the oldest IOUs, debt tokens, a clay tablet called a shubati, which have been recovered in their thousands from the temples of Babylonia and Sumer in the desert sands. And they specify the debt, the debtor, the creditor, the date, what is due, interest sometimes. There's a whole institutional and regulatory framework around that. So I think Albert Einstein said that humanity has made 3 great inventions: fire, the wheel, and double-entry bookkeeping. So that's not a modern invention which followed money. No, money followed credit relations when credit tokens like these and tally sticks and others began to circulate as means of payments. That was money, followed by coins. Coins came much later than that. And I promise this will be relevant to the topic. It's 5,000 years ago. It's still relevant. So some Bronze Age economics is what we need instead of DSGE models. Because when you go on and say, well, what kinds of credit are there, and so if we want to make a distinction between useful and not useful, that's a terribly hard thing. A good place to start is to say, well, let's look at what sort of credit is good for economic growth. And that may sound very bland and very obvious, but of course we can go on and then say, well, what sort of credit is good for green economic growth or for equal economic growth? So those are important questions, but I just restrict myself to the question, what is good for economic growth itself, expansion of GDP, for the moment supposing GDP is a good measure. And classical economists and later economists have made a distinction between credit to the real sector, which expands transactions in goods and services, thereby expands GDP, which is the sum total of those transactions, and credit which goes to other purposes, which by definition is credit going to property and asset markets. And at turned our attention to this yesterday evening after the dinner, that most credit today, the overwhelming majority of credit flows, is for asset and property sectors. And economists like Marx, Schumpeter, Keynes, Minsky, Gottlieb have drawn attention to this, and attention also to the importance of this. In our time, people like Richard Werner, Michael Hudson, Steve Keen, and others, Gottlieb, have explained why this matters. And I want to say a few things about it today as well. Basically, it matters because it builds up systemic leverage. You can think about the social usefulness of the financial sectors bottom up, and we've seen some of the immense complexity of the financial sectors and the immense variety of things that can go wrong. And you can try and think of regulation for each of those things. That's incredibly difficult, I think. You can also take a top-down view and say, well, what are the macroeconomic outcomes, and how can we prevent those outcomes from happening, or punish those outcomes, disincentivize those outcomes. And from a helicopter view, you might say, the big outcome is systemic leverage. And by systemic leverage, I mean not the leverage in any single balance sheet. It will be there, of course, but leverage of the economy. Simply the total amount of debt relative to GDP, which is the ability to repay the debt. You can be a bit more precise there. So you need to think in terms of stocks and flows. You need to specify financial flows, which is impossible in DSGE type and all general equilibrium type of models, right? They're good for certain purposes, but they have financial black holes. They have blind spots for finance. So we need other models. Models like the stock flow consistent models that Wynne Gottlieb and others developed do a very good job there. This is from my own work. I've done this for a number of countries now. This is credit flows in the United States over the last 60 years. So we are shortening the time span already from 5,000 to 60 years. What you see is that credit to the real sector, the light blue line, is around 100%, as it should be, because it expands the economy. It expands transactions in goods and services one-on-one with the credit extended. Okay, so theoretically it should be one-on-one, 100% with GDP, which is what you see in the long term, which was observed by people like Marx and so on, by Gottlieb, by Federal Reserve analysts and so on. This is logically implied, and you can find it in the data with some mismeasurement. The US is a bit of a special case there, but you can see it in all countries so far that I've looked at. The red line, of course, is credit to finance and property. So by that I mean all bank credits, that's loans made out by US banks in order to support the purchase and the trade in financial assets and instruments and in property. Mortgages is, of course, the biggest category there. You see that it's fairly low in the 50s, the US coming out of the war with low levels of leverage. It's rising relatively gently until the 70s, then it's rising much more steeply with the financial liberalizations of the 80s, and it's really accelerating after the dot-com burst and the mild recession, and then it's going down, of course. It's going down a lot, and then real sector debt is going up. That's one of the detrimental consequences of running up a lot of debt in asset markets, property and financial asset and instruments markets. So basically, credit is what credit does. That's my answer to the question, what is a socially useful credit system? Well, for a start, you know, we can say a lot of things, but for a start, it's a system that supports economic growth. Let's keep things simple. We have known that since Schumpeter. The Babylonians knew it, actually, but we've known it as academics since Schumpeter. And most of our credit system does not support economic growth in the sense of supporting transactions in goods and services. Most of our finance system, most bank loans, support transactions in assets, increase asset prices, and increasing asset prices has a number of detrimental effects on the economy. It also is helpful to the economy at low levels, but not at the levels that we know, as I'm going to show now. For instance, when you ask yourself, well, how many dollars of bank debt have to be created for $1 of GDP growth? Okay, now during the so-called Great Moderation, which is celebrated by monetary economists as the pinnacle of wise monetary policy, this was 4. From 1984 to 2011, on average, $4 of bank debt had to be added to the total debt stock of the United States for $1 of GDP growth to be realized. In an earlier period, perhaps part of the golden age of capitalism, it was 2, so it had doubled. What does it mean for a society when it needs to build up debt levels that rapidly in order to maintain levels of growth, which were actually moderate? So we can come to a sort of typology and say when credit helps, hinders, and hurts. We are familiar with the help story. All the textbooks tell you the functions of credit, the function of a financial system. Credit is good for growth, okay? And that seems to be true at relatively low levels of debt to GDP, which means, because debt to GDP in the real sector is always 1, it doesn't change, all the increase in debt to GDP is due to debt to credit, which is the same, increasing in the property and asset market sectors. At relatively low levels, credit helps. And that's logical because asset markets have an important function, especially in sophisticated economies where people need to do saving, risk diversification, and so on. Yeah? So there is a role for some credit extension beyond credit only going to the real sector. Also, Schumpeter and Minsky explained that you need to extend credit beyond current output if you want to have growth. Yeah? So there is a role for that. I'm not bashing financial market, non-bank financial markets and property markets tout court, but there are fairly strict limits of how helpful they are. Of course, they hinder at higher levels, and I'm going to say a few things about how it hinders economic growth, and it hurts in a financial crisis. And we tend to think about credit helps growth, and of course there is a risk of crisis, so you need to manage it, but it actually high levels of credit extension and therefore debt creation hinder the economy already before a crisis. Before I go to the practical implications, the analytical implication is that we need models where the financial sector is explicit. Currently, macroeconomic models are like this. They have producers, consumers, and the government in a closed economy model. What we need is this. We need an explicit financial sector. If you don't trace flows of credit and debt, interest payments, the burden that it is to the economy or the benefit, you have no idea and no clue when a financial sector will be coming. That's why the credit crisis was such a surprise. There are no models tracing credit, so then a credit crisis will, of course, come out of the blue. We can do better than that. This is a picture from a paper by Michael Hudson. Now, you might think, and outsiders might think, that economics is about money and why it's good, as Woody Allen quipped. Economics is not about money, unfortunately. As I said in the beginning, the cutting-edge models have no banking sector at all, have no money flows, except for an M3 variable, which is money, but it doesn't trace the other part of the balance sheets, which is the liabilities that come with that money, the debt buildup of financial expansion. So, as Joseph Schumpeter said, we need a credit theory of money. Forget money, think about credit relations, because that's where you see the dynamic and that's where you see the different potentialities of credit. So we need a new analytical focus. I think the key question in our assessment of is the credit sector, is the financial sector useful, socially useful? Is it in sync with the economy? And if you look at this graph from another paper of mine, where I studied the Great Moderation, you can see that the Great Moderation was so moderate, there was great stability in unemployment, GDP, precisely because financial markets were so unstable and were expanding. You see that credit creation was in line with economic growth, was moving up and down with economic growth until the mid-80s, and then started to develop a dynamic of its own, which is a very bad sign. When you do a Granger causality analysis, you see that in the first period, the economy, GDP growth, is a causal factor for credit extension. In the second period, it's the other way around. Finance starts driving the economy. It's what we call financialization. And remember the other graph, that's with rising levels of debt. If you don't have stability in your credit system, if you have too much credit, what will happen? I think that's an important question, and we can attempt to answer the question, what is a socially useful credit system, by looking at the pathologies, right? Tolstoy said that happy families are all happy in the same way, which is quite boring, and we see a well-functioning credit system doing roughly the same things in very different times and places. 18th century Scotland, 19th century Germany, 20th century miracle economies in East Asia, Korea, for instance. You see the bulk of credit going to the real sector and supporting fixed capital formation, innovation, technological progress, and very little credit going to mortgages and to financial market development, to boost the stock and the level of prices of financial assets and instruments. That has been always a very modest role in credit systems which supported high economic growth. China also, until recently. But Tolstoy also said that unhappy families are each unhappy in their own interesting way. That's how you get the most interesting literature, also how you get the most interesting analysis. So I'll briefly talk you through a number of pathologies that you get when your financial sector is sending too much credit to the property and financial asset markets, and therefore the net debt buildup, the systemic leverage of the economy grows. The first is instability. This was from a paper by Joe Stiglitz in 2000 and others. Shows again that at about 100% of credit to the private sector relative to GDP, you have minimal volatility. So too much credit means more volatility in the economy, which is logical because every financial crisis is an asset market crisis. So the more credit you send to asset markets and the higher the debt buildup against assets, the higher asset prices go, the lower they can fall, the greater your probability of a crisis, of a finance-induced episode of volatility in your economy, right? The second is inequality. This is a graph that I made for the US economy again. The blue line is the income of the top 5% relative to the bottom 20%. And the red line is the same line I just showed you, credit to going to asset markets. Note that they move together, which again is logical because as credit systems, financial systems become more and more non-bank financial asset systems, property systems, they come to resemble more and more a Ponzi scheme, where you need new loans to service existing loans. That's the definition of a Ponzi scheme. That's exactly what you need in asset markets, property markets, with rising prices. And a Ponzi system is a pyramid game which sucks money flows from a very large base to the top. Inequality, of course, right? So there's no mystery about why highly financialized economies are very unequal economies and why we have increasing inequality. So, of course, the economy is complex. The world is complex. There are many ways in which inequality works out, as Adair Turner yesterday explained, but it's also quite simple. There's a major reason behind this. There's no mystery there. Another is, of course, less investment, and by that I mean less real investment. There's a lot of investment in financial markets, but that's not fixed capital formation. That's not directly technological progress. At best, it indirectly supports technological progress and fixed capital formation in the real sector. But on average, at higher levels of credit going to asset markets, it doesn't. There's a negative inverse relation between international financial flows and fixed capital formation, as this graph from an INET report from last year shows. And therefore you have lower growth. And this was from a paper by Arcand et al. Called Too Much Finance. Okay, a number of papers have come out last year. This one, Stephen Cicchetti has done a paper called The Real Effects of Debt recently, where he also estimates, simply empirically estimates, what is the optimal level of debt for an economy with respect to growth. And in different methods and for a different definition of debt, he comes out at about between 90 and 110%. Now, in the US, the financial sector, all debt, only the debt by US banks to the US economy is about 4 times GDP. It's not 100%, it's 400%. Okay? And that's not even counting the shadow banking sector. So, another thing that you get is more capital flows. It's not, and this is the result of financial liberalization. If you liberalize that, you get international capital flows. For the case of Greece, the euro project basically was, there's nothing inherently wrong with the euro perhaps there is, perhaps there's not. In any case, it happened in a regime of liberalization of capital flows, which boosted up asset markets. And if you look at loans going to the productive sector to boost transactions in goods and services, and loans going to mortgages, consumption, and so on, there's an almost one-on-one again, almost one-on-one link with capital inflows. Yeah? So the liberalization and the growth of international capital markets does the same thing as I just showed internally, domestically for the US economy. And again, public debt was not a problem with Greece. It followed on this buildup of debt. It only became very big after these debt flows had built up. Now, I must spend the remaining minutes of my talk before Thomas gets very angry with me. Okay. So what is the upshot of this? Well, the first upshot analytically for me as an economist is to build models and to collect data that chart the economy's credit flows and the return interest flows and what it means. And that's what INET pays me to do, and I'm very happy for that to do. Practically, what does it mean in terms of policy? Well, we need to look at two things. The first is we need to solve problems from the past, and the second is we need to prevent them from happening again. And in whatever measures you hear discussed these days, I suggest that you do a litmus test in the back of your head. Does it support growth in credit to a non-financial business? That's the economy, right? That's the economy. Or does it not? Now, that's a controversial thing to say, but I'll just put it to you as a question. And does any solution shrink the debt overhead? And I want to spend a few words on this because this is important. The financial sector is a creditor to the real economy. The real economy is a debtor to the financial sector. It needs to service all the financial obligations and loans and so on. And therefore, each month, if we look at income, household income, that's not disposable income, not even after tax. Each month, a large drain of money out of the economy goes to the financial sector, servicing loans, all kinds of financial obligations, investments, and so on. Okay? That is now about 3-4 times as large as it was in the 80s, because the graph that I showed shows that the US non-bank financial sector is now 3-4 times larger than it was in the 1980s. Do we really need all the 3/4 of the growth since the 1980s? Apparently, we think we do, because all our policies nowadays are geared towards saving the banks. And John Kay has written a book for people who are not in the industry, but of course all the decisions are taken by people who are in the industry. And their first idea, their first thoughts are always about how do we save the industry. My suggestion is we shouldn't want to save the industry. Just go back to credit and debt. Go back to Bronze Age economics. Every financial claim is a debt and is a drain on the real sector. It may be worth to have that drain. It may be worth to have that debt if it gives you extra diversification of risk or whatever. But it's a cost, in any case. It's a cost. Do we really need that cost? Does the benefit justify that cost? Therefore, if we want to get rid of the negative effects of what we did in the past, of the large debt overhead, we need to shrink the debt. And because the non-bank financial sector and a lot of banks live from debt claims, it is inevitable that this sector has to shrink. It's inevitable. It will be painful, but it will happen anyway. It will happen anyway. It will happen either by a very prolonged period of austerity, recessions on and off, low growth in any case, where there is a continued drain out of the real sector to the financial sector, and that drain could be effective demand for goods and services, could grow our economies. Now it's growing, or it's keeping in the air, the financial sector, which is really bloated. We shouldn't want that. So instead of policies to save the financial sector, we must look for policies to shrink the financial sector. That will be painful. We must think carefully about where the fallout will be, which balance sheets will be hurt if we do that, how do we compensate them, how do we ring-fence essential functions of the financial system, payments, retail banking, and so on. We can think about all that, but first we must realize we must shrink the debt, and therefore we must shrink the financial sector. Financial sector people generally will not tell you that, because that's not what they think. And that's quite logical. I'm not blaming banks. I'm not here in the business of bank bashing. But for a macroeconomist, to me, that is obvious. Let me just limit myself to myself. Okay. Austerity itself is not a solution. So one way to shrink the debt is austerity. I'm not sure that it works because the GDP will fall faster than the debt and you end up with leverage. A lot of studies on IMF programs, which in the past adhere to very strict austerity, and I'm told they sometimes still do, a very large number of studies shows that this doesn't work. It has been tried in Africa, Asia, Latin America. It's come home to Europe now. Stop it. It doesn't work. Nor is QE. Okay, people who understand quantitative easing, which means that central banks are buying back their own bonds and increasing reserve balances of commercial banks in return. The idea is that the commercial banks get money from the central banks and pass it on to the public and stimulate the economy. Now, that's not what happens. That's not at all what happens, because lending to the public is not something that is the same as reserves with the central bank. It's not even stimulated by reserve with the central bank. You can clearly see this in this paper that I did with Jeffrey Gardiner. You can see an unprecedented increase in Bank of England reserves over 2009, a quadrupling, unique in the 3-century history of the Bank of England. And you can see the blue line, bank loans to the private sector, just continuing their downward way. We're doing the exact opposite here of what we're supposed to do. We need to get more credit to the real sector and less to the financial sector. Austerity starves the real sector of credit. It's the opposite. Quantitative easing kind of measures, they have other purposes, but they flood the asset markets with credit. It's not a coincidence that we have excessive speculation in food price commodities right now. All this money is still around. It wants a return. It's chasing commodities, is doing harm to the real sector. We need to get rid of it one way or another. If we let nature run its course and do it spontaneously, it will be very painful. We need to do it in a managed way. Okay, I need to stop, and I'll stop with, after all, I'm in the land of Goethe. Less is more is actually his quote. In der Beschränkung zeigt sich erst der Meister. We need less debt, and then the financial sector will function better. And it actually continues with, und das Gesetz nur kann uns Freiheit geben. You can only do that with regulation. Thank you very much.
Thank you.